contrarian, leave it to contrarian badass Reggie Middleton. He called the housing crash, he called the collapse of Bear Stearns and Lehman Brothers, and the crisis in the Eurozone banking system. Reggie Middleton.
So moving forward, so we went through we went through what tokens are. You went through risk-adjusted value of tokens. Now, tokens come from somewhere, okay? The entities that issue tokens also have significant value. The first two entities, Bitcoin started literally from white paper. There is no entity. Bitcoin is, the anarchist nirvana, because white paper, code, value, and that's essentially how it works. There is a small group in charge of shepherding the Bitcoin code, and there are a lot of volunteers that submit to GitHub, but there is no real governing body. Because of that, you have interactive politics. You know, this group stands to gain if you do X, that group stands to gain if you do Y, and it's slowing the development of Bitcoin. But, interesting. Then you have Ethereum, which is the second largest, okay, out of many, and that doesn't mean it's the second best, it's just the second largest. Ethereum was founded by those who were Bitcoin enthusiasts, but didn't believe that Bitcoin was moving fast enough. They basically forked Bitcoin. They didn't even fork it. They started from scratch. They did a crowdfunding. They raised $18 million in Bitcoin. Didn't get to keep all of it because Bitcoin crashed shortly thereafter. I think they got chopped in half. But they hired developers from around the world, opened a foundation in Zug, Switzerland, and created a structure where a not-for-profit was in charge of developing the Ethereum platform and the technology, and then they spun off or created for-profit entities that consulted. Okay, and that's Consensus in Brooklyn, led by Joe Lubin. These guys are very smart, both on the business side and on the technological side. This is no small feat, and valuing this is very, very difficult. If you're the typical analyst, CFA, you're thinking in terms of comparative values, DCF, earnings, revenue growth margins. That's not the way it works. One reason is when you create a platform, you don't want to make money. You don't want to charge profit, because if you do, you slow the adoption of the platform. The more something costs, the less people would buy it. The cheaper something is, the faster it spreads. Perfect example would be Google. Okay. In 2009, early 2009, Google had squat to do with cell phones, except for Gmail, where people use them on cell phones. They bought Andy Rubin, and his startup is Android. They bought Android from 2009 to 2017. That is 8 years, 7 years and change. Google's Android is now the most used operating system in the world. They've surpassed Windows. They have 89% of the market share, which is almost all of the market. And they have the most advanced devices out. This is all in 8 years. How'd they grow so fast? They gave it away for free. And Google is a master at doing this. If you look at the media companies, you have a couple of people in the media. I think they can tell you, if you go back 20 years, the media was very different from what it is now. You have fat margins, you have revenue growth. Google has eviscerated a lot of the media companies who really didn't have their act together by giving away their core product free. Maps, remember Garmin, GPS devices, you don't see people using those anymore. Everybody uses their phone. Email, cloud services, you name it. So we call this, or in my company, we call this cost shifting, where you go into a business process, you attack that industry by giving away its most profitable service or product for free, but you charge with the ancillary product that is needed to make use of the service or product. Google's an expert at it. This is what platform companies are doing, okay, the digital currency platforms. They create something, they give it away for free, okay, with volunteer coders and foundations, and then they attempt to profit by writing stuff on top of it, okay? But they take this one step further. They can, let's not use a particular name, but someone can make a platform, okay, a token, okay? They can give the service away for free, and it can be very useful. Let's say it's a free version of Netflix. It allows you to download and view movies without paying any fees, okay? Normally, this company will go out of business, but the tokens that are needed to access it will have value. The more people that use this Netflix service, the higher the demand for that token, And the higher demand with the fixed supply means a higher price token. The supplies are almost always fixed, or if they're not fixed, they're heavily controlled by the issuer. And so they make money through economic profits, capital gains of the token. And that's how they profit at the platform level. We call this layer one. By doing that, you can make a fortune from an economic perspective, but from a GAAP accounting perspective, lose money day and night. You could break even or lose money on margins and profits. You could have almost zilch revenue just enough to cover costs. But that's what you want. You want to spread this as far and wide as possible. An example is when Ethereum was launched in a crowd sale, 2015, 14, whenever it was, one Bitcoin bought you 2,000 Ether. And I think a Bitcoin is about $240. You looked at it, what was it?
Like 240.
$240. So $240 bought you 2,000 Ether, okay? Right now, it's trading just under $90 for one Ether. So let's say it's 90. So think about that return, okay? Significant. So you can afford, if you're holding Ether and you've got it at cost, you're sitting on a decent amount of money. Bitcoin has it's a longer period of time, but it's even a stronger return at 30,000%. So this platform area is where a lot of the money is made. Now, we have a framework for valuing that. I can't get into that now. I actually had reports, valuation reports to give to people of Gnosis. Gnosis was a company that spun off from Consensus, which was the Bitcoin consulting firm. They had the ICO, I think, last media has it where they sold out in 5 minutes. They raised $12.5 million in 5 minutes. Okay, that's not really accurate. It's more marketing. What they do is they pre-sell a market for for 2 months beforehand. They get commitments, and then at the launch of the ICO, those commitments come in. So it seems like they sell out fast. But there was demand for it nonetheless. I'm not poo-pooing it. Definitely was demand. They were oversubscribed. Okay, those tokens now have significant value. Okay, I think they're trading at $36 a token, up from close to nothing before, and that significant value. I think they released 5% or 10% of tokens, and 90% are kept in reserve on their balance sheet. So that 90% is at $30 a token. Now, economically, you can't dump that into the market. If you did, you drop the value. But you see there's significant value there. So that's a way of making money that's not captured in today's GAAP accounting. So that's layer one. Layer two is when you create services and products on top of this free platform for people who are developers. So if you want to write something for Ethereum, you have strong engineers and developers, but you don't want these guys coming up to speed on Solidity, which is the name of the developing language. They create templates, frameworks, etc., to get your developers up to speed very quickly, and they sell that to you, and you'll gladly buy it because if you're a CTO, you can say, well, I could put $800,000 of resources in coming up to speed, or I could buy this for $50,000. Okay, $50,000 a pop times the Fortune 500, times the Fortune 2000, times the Russell 2000, Europe, Asia, Northern Africa, MENA, that adds up quickly. Okay, that can be valued using regular GAAP accounting if you know what you're doing. Yes.
So now, once that happens, because it's just it'll be like another product or service, right?
Right.
In the market. So number one, is there a market for it? How do you sell it? And how do you kind of monitor those sales to see if those products are actually really selling?
Okay. Well, let's use Ethereum. Ethereum is backed by every major bank out of the top 5. Every major bank and every major technology company in the world. Microsoft has a full-time employee that sits in a Consensus office. I'm pretty sure Deloitte, said he's a rep from Deloitte and Touche is heavy into Ethereum as well, if I'm not mistaken. Am I? Mm-hmm. Okay. You have IBM, right, which donated code back and forth to the Hyperledger with Ethereum. You have JP Morgan. You have Citibank. As a matter of fact, a lot of the big banks that pulled out of the R3 consortium. R3 is a consortium of a bunch of banks that get together to, I'm still not quite clear what it is they're trying to do, but something blockchain related. The larger banks with more technological resources have all pulled out, and each one that's pulled out has either adopted Ethereum or forked Ethereum and put their own layer on it, adopted. So there is demand for it. And consensus is probably 200, 250 employees now, easily, if or possibly more than that. So they've grown a lot. 3 years ago, they didn't exist, okay? So there's definitely demand for it. Now, above that, you have layer 1, we have layer 2, then you have layer 3 on top of that. Layer 3 is when you have prepackaged applications that you can sell, like Microsoft Office or like PowerPoint or Photoshop. These are for lay people who don't care about programming at all, but would like to have a cool app that can do X, Y, Z, okay? Or corporations who, you know, would like it done for them. That is where most of the money will probably be made over time. It's an annuity stream, difficult to account for, but over time, that's where most of the money will be made. Now, we've launched our own token, our own ICO. I don't like calling it ICO because you have a lot of regular issues. It sounds a lot like IPO. And we're selling software. We've tokenized our knowledge. The little speech I'm giving you now, we can tokenize this, and we have tokenized it. We can sell tokens, and now if you want expertise on, say, finding the next 30,000% banger, you know, you can redeem that token back to us, and we can help you. You could buy research and development from us, or you could participate in our machines. We have what we call financial machines, where we're taking these smart contracts, and we're using these smart contracts to replicate industry verticals. One industry vertical we're replicating is hedge funds. You know, the smart contract screens, you know, potential newcomers in the digital space. Very simple screen. If it passes muster, it contracts out to our firm to do the heavy-duty research, okay? If it's a yes after that research, it then buys the tokens of this company. And it does this for actual company corporate tokens, issuing entities, and for platform tokens. So the platform token would be Ether or Bitcoin. Issuing entity tokens would be GNO, which also would like, GNO is a token for Gnosis, or, you know, XYZ or YZX, okay? And over time, hopefully, you know, it grows in value. When you purchase your research, it's interactive. So now we've melded the difference. We've blurred the line between research and actual asset or value exposure, and it's one and the same. So basically, we took the Wall Street model and we turned it upside down on its head. Currently, what the sell side of Wall Street does is they give away the research for free, which should tell you exactly how much it's worth, right? So if they give it away for free, but they charge you for the commissions and the transaction fees, etc., they charge you a lot, okay? Now, with the advent of the blockchain, these transactions have a very, very low cost. Such a low cost that I say, with the smart contract, the financial machine, I'm not going to charge you anything. And it's not me. The financial machine will not charge you anything at all, okay? So all transaction fees, everything else, you get at cost. Whatever it costs, the same thing to the blockchain. We will charge you 3% for the research fee and 2% for engineering and development, because this is an autonomous machine. Autonomous means it rests and operates on its own. We don't control it, okay, but we do maintain it, and it takes developers and engineers to do that, and the research is not easy. So that flat 5% competes with, what's the going rate now for hedge fund fees in Connecticut and New York? There's a little downward pressure. 1 in 10. It used to be 2 in 20, but I guess a lot of institutions started pulling out their calculator.
Marginal money.
Yeah.
If you're really good.
Yeah. And so at 1 in 10, do the math, 1% of assets under management, 10% incentive fee, okay, performance fee. Let's suppose you have a big, you know, a 30,000, 3 times return. So you have $100,000 in, right? It goes up 300%, okay? So now you have 400,000, okay? The asset manager takes 10% of that 300,000 gain, okay? Plus 1% of everything. And then next year, the same. Compare that to a flat 5%. You're talking, help me with the math, 90,000 plus another one, 91,000 versus 20,000, right? Okay, so 91,000 versus 20,000, much cheaper. You're talking about 72% cheaper. Is that about right? Smart guys with math? Okay, roughly, right? Okay, so imagine if you could get the same result, right, but one guy charges you 3 times more, 4 times more than the other guy, right? You'll almost always go with the guy who charges less. Now, over time, these fees add up. That was 1 year. Let's compound those fees. The following year, you get another 3 banger, okay? Now, that 72% is compounded even more. Now you have a bad year, okay? In a very bad year, this 5%, okay, is 5%. The break-even portion is much, much lower on the machine because the machine does not have asset managers to pay, okay? And so this machine can underperform by roughly 71%. The actively managed or a non-machine, human-driven fund, and have the same net return to the LP or the investor. So that means we could do a lot worse and still break even. Most active managers, except for the guys here, of course, most active managers don't beat the S&P 500 index, passive index. Most of them don't. The few that do, do a good job. A lot of them have uncorrelated returns, and that's a plus, so there's demand for that. So speaking of correlation, if you look at the sheet that I sent out, these big, massive returns on Bitcoin, 30,000%, and the big, massive returns on Ethereum, they have a correlation to the S&P 500 of between negative 0.1 and at the most, I think maybe 0.3. So the most correlated is Litecoin, and the least correlated, I think, is Dash. But in general, the uncorrelated will have a negative correlation. For people who don't understand what correlation means, it's basically when all of your assets move in one direction. Now, that might sound good when everything's moving up, but when everything's moving down, if everything just drops, you go from 500,000 to 300,000 because, not only do you have all your eggs in one basket, but you got all those eggs from the same bird. Now, if you had uncorrelated assets, when one asset goes up, the other one goes down. When one goes down, the other one goes up. The third might go sideways. You have now protection, in your portfolio. So a lot of entities, pension funds or high net worth guys who have advisors or who are very decent at math, say, I would hire your firm, right, to give me uncorrelated returns, even though your returns are not that, strong, but your lack of correlation reduces the risk in my portfolio. Imagine if you had significant returns and reduced risk. That's a win-win situation. So here we are back to investing in digital assets again. So, have I bored anybody? That many people? Okay. Any questions besides why you're boring me? No questions at all? Because I'm going to start quizzing you.
I'm going to probably ask the question that most people in the room want to know.
Okay.
How do you make money?
How do you make money?
Like if let's say if someone gave you right now, say, hey Reggie, I like your ideas. This sounds great. We know it's a new innovative wave, like Bill Gates wanted to do. Whatever, put every computer on every desk in America. Right? So someone say, I'm gonna give you $100 million.
Okay.
How do you turn that into $1 billion or 500?
Okay. What am I gonna say?
You're gonna research the companies.
You're gonna buy Veritas tokens, the tokens from Veritaseum, and that's one way you can make money. Now, I say that only 15% jokingly, which means I'm actually dead serious. So another 85%. Let me explain why. Okay, the tokens. There are a lot of companies doing these token offerings now. A lot of them basically have a fancy website and a white paper. It's not even a real white paper. White paper is an academic thesis. These are guys who are writing marketing on a white sheet of paper, basically. What we're doing is we're doing the cost shift, where we're destroying business models by eliminating margins, and we're bringing very high-end research, the same research that found Bear Stearns and Lehman Brothers, etc. We're bringing it to this new market. It's right now, it's a wild west. Nobody does real financial analysis. If you look at the so-called research reports, not one of them have financial statements, valuation, projection, nothing. There's literally nothing there. It's a sea full of nothing.
Sales material.
And there are there's one site, I'll tell you, Smith & Crown, the guys really seem to know what they're doing, but more from the technical side, strategic side. But from a full 360-degree side perspective, there's not a lot there. We're going to bring this in very hard. As a matter of fact, I meant to bring the biggest, most prominent offering I meant to bring today, but their printer wasn't working, the other office wasn't working, it wasn't in the cards today. But contact me via email and we'll work something out. The only way to get this access to this research is through the tokens, our tokens. I don't want to talk to anybody if you're not a token holder. Basically, we use the tokens to purchase the research. The only reason you can get access right now is because the financial machine that will digest this research and buy the tokens is not done yet. And we're working on it. And we're pushing to get an alpha out, hopefully in 30 days. Once that alpha is out, now research is not what you used to. Instead of having PDFs or papers that you throw in the garbage, research is this machine that actually buys tokens that it has conviction in. Okay? These tokens go up and down significantly. Right? I think I'm fairly well versed in this. I think we're very unique. This morning, I just agreed to have 3 analysts do just digital assets. Okay? And I have 1 developer, 1 engineer just on the digital asset side, very specialized. This is a team of 5, and hopefully more. We have another 15 days for the offering. Once that's done, we're going to shut that down. We're going to limit supply. We're not limiting supply. It's done. We have our reserve on our balance sheet, but that reserve on the balance sheet is reserved for institutions that come in. Right now, there's really no real institutional demand there because they don't understand it. Once they start looking at these numbers, 30,000% return, highest risk-adjusted return over time, negative correlation in assets, there's going to be a flood. When that flood comes in, there's only one research provider. There's no S&P, there's no Moody's, there's no Goldman, there's just Veritaseum and Reggie Middleton. So, significant demand, very little supply on the research side. On the financial machine side, very little cost, poison to any fat margin business. With all due respect, hedge funds are fat margin businesses if they can take 20% of gains and not outperform, everybody else. All due respect to hedge funds, that's not y'all, of course. But did I answer your question fully?
Yes, and that kind of go into my second question. How is now the supply controlled of the tokens, or who controls the supply of the tokens?
Well, it's a fixed amount. We have 100 million. There's a small contract that created 100 million. We'll sell up to a certain amount. There's a game that is played in the market, and the game is basically controlling supply to manipulate price. Okay, so they put a very small float out, they get a big pop. You know who did that? Because I was here yesterday. Snap, which is a company that does Snapchat. They released a very, very small amount of their issued shares to create a pop. These shares were practically tokens. You had no voting rights, you had no dividend, you had nothing. All you had was, a Snap digital blip. So it's basically a token. And on top of that, if you did any real analysis of the company, you saw the company's growth was slowing before the IPO. Okay? But for some reason, Goldman and Morgan brought them to market and raised the price 2 or 3 times, oversubscribed, and Snap collapsed back to the IPO price yesterday on their first earnings report. And if you read my blog, I made it very clear that was going to happen. There was no way out of it. Okay? So most tokens have the same situation. They just don't call it stock. You don't have voting rights with many tokens. You don't have revenue sharing. You don't have profit sharing. You don't have dividends. So you do need something or somebody to show you the way until you learn. So that's how you control it, but you shouldn't control it. When you try and control supply, you create volatility. That volatility might seem good for the early adopters because they could get out, but it destroys your business going forward, particularly if you have a platform business. Because the more stable the token is, the more people are likely to use it, especially for transactional services, because you can predict what happens. You don't want to buy something for $20 and then you go and sell it, it costs $4. Did I answer your question fully?
Yeah, it gives me a better understanding.
Okay. Anybody else?
So these tokens you have are really like a little fund of funds of other digital currencies, and you do the research to decide which ones to own?
No. Bad language.
I mean, but in actuality...
Let me explain what the tokens are. Think of Walmart gift cards. Okay? So you go to Walmart, you get a Walmart gift card, you pay Walmart money for it, and now you have a gift card. This gift card, so we have the gift card here, okay? I hold this gift card from Walmart in bearer form, which means whoever holds the gift card has it. So it's a bearer asset. I can do several things with it. I can go back to Walmart and say, I'd like to buy a flat screen TV. Here's a gift card, that will pay for it. That's one option, okay? And Walmart will give me that TV at a predefined value for the gift card. Now, let's suppose Walmart decides to move to the blockchain and all the blockchain hype. And everybody's like, wow, those Walmart guys are smart. So Walmart stock and all of their products shoot up in demand, hence shoot up in price. So I could still take this gift card token and I could redeem it at Walmart to get a TV. Say I paid $500 for it. I could give it to Walmart for $500 of value, but that TV is now worth $2,000. And I can sell it to him and he'll give me $3,000 for it because now there's much more demand. So I have a choice of redeeming it, or I could sell it to somebody else, or I could go to a third-party market, or I could just hold on to it because I think it may go up in price, okay? The reason why we structured it like this is because we don't want to sell securities. That's not legal. What we do want to do is we want to sell software that allows people to participate in what we call the peer-to-peer capital markets. Let me just finish this thought and move on. So we want to participate in the peer-to-peer capital markets. The peer-to-peer capital markets are basically everything I explained, where Peter could do business directly with Paul without an intermediary, without a third party, without Goldman, without the central bank, without anybody. Okay, they do business directly. And they can do this business directly without counterparty risk or credit risk. Not only is it not riskier, it's actually less risky, safer. Okay, the financial machines that we're building allow this to happen. Like the financial machine that you call the fund of funds, it's not really accurate. It's not a fund, it's a software pool, right, that buys other software and it gives anybody who has a token in it exposure to whatever it buys.
What are you hoping will happen if you own a token?
If I was a token?
If you buy a token, I send you $1 million, I own a token.
Mm-hmm.
What am I hoping for?
Well, there's a variety of things, okay?
To make money. I'm hoping to make money.
Okay, and you want to increase economic value one way or the other, okay? But, and I continuously have to say this, okay? And I've said it several times. We're selling software, tokenized knowledge. I started with tokenized knowledge. If you're a corporation, there's a couple of ways. Suppose you're a hedge fund, okay? You buy some tokens. You want to get into this game, but it is difficult to value these. And you want help valuing companies. Well, you take your tokens, you redeem it to Reggie Middleton or Veritaseum, and say, help us pick some stuff out. Help us build a contract. Help us integrate this into our system, right? That's what the tokens are for, digitized knowledge. You bought the knowledge as a commodity, tradable, bearable commodity. Or you could take this token and you could buy access to one of the financial machines. These financial machines are basically research that act, okay, autonomously. Or you could take the token and you can speculate, okay, which is not what we are selling or recommending, but speculation is speculation. So if you think it's going to go up, just like the Walmart card, you buy the Walmart gift card, you think Walmart gift card might be worth more, you can do it. Walmart is not selling you a security. You're choosing to speculate on. But there's functionality above and beyond that. Now, you did ask to say something.
All right, so I just want to be clear because this is my first time here. So
Okay.
Veritaseum,
Right.
Veritas.
Veritas, Latin truth, EUM.
Okay, that is a peer-to-peer, the tokens, or is it similar to cryptocurrency, or is it?
Veritaseum is the name of the company.
Right.
Okay, to start up. The Veritas is the tokens,
Okay.
the little pieces of software that we use to commoditize knowledge, and they act as keys to start the financial machine and get in.
Okay.
So it has two basic uses.
And it works on the same technology as, say, like Ethereum.
It's built upon an Ethereum platform. Right now, the value trading platform that I explained, we started on Bitcoin. That's still sitting on the Bitcoin network. We pulled it for regulatory concerns because when the CFTC decided they would regulate Bitcoin, it could be interpreted that we were a swap execution facility. I don't want to have this discussion, so I just pulled it and we're going to rewrite it to, comply. And it's easier, it takes less brain power to write for Ethereum because Ethereum was made for this, where Bitcoin is a little more difficult. So more flexibility on Ethereum. Less network effect, more flexibility. Remember the value gauge where you had utility value versus network value. This is a sliding scale. Anything else? Yes.
So if I buy $1 million worth of Veritas, and I say, great, Reggie, pick out $1 million worth of tokens. Where do those tokens go? How do I get a hold of it? Do you open an account for me? How does that work?
Well, it depends on how you do it. If you just want to use this as a consultant, then
I want you to do everything. I want you to full service.
Oh, the financial machine. You send your token to the smart contract, and the smart contract acts on its own. Now, you wouldn't be sending it to Veritaseum. You'd be sending it literally to Skynet. You know, think of it, remember Terminator, Skynet? This is Skynet for Wall Street, not Skynet for you, okay? So you send it to Skynet, you send your tokens in Skynet, Skynet acts on its own. Very, very rudimentary with AI, okay?
But are the tokens held in a wallet? Where are they held?
They're held in the contract.
They're held in the contract.
Right. Ethereum
And how do I
contract.
cash out that contract?
There, depending how the contract is written, this will probably have quarterly windows where you can pull in and pull out. It has to be predictable because the contract itself has to manage tokens, okay? So they have quarterly. We are hopefully, I want to have it out for now, but of course, you know.
How's the value? Is it like a weighted average of the underlying coins?
Yeah, it's a weighted average, price-driven average, and volume-weighted average. But, you know, remember, these tokens have different attributes. There's some tokens that may have revenue sharing or profit sharing. Some have voting rights. Between the research arm that the machine contracts out to, because it can't do but so much on its own, and the machine's own algorithms, decision matrix, it decides whether XYZ token is worth getting. And the sky's the limit. You could tokenize everything. You could tokenize 5-year cash flows from this building, okay? And you could trade those with the 5-year deed, value of the deed for the building across the street. You could do a swap on that. And we actually have software to do that. That was the first product we built. So once we get the verticals up for the financial machines, we port over our value trading software, and now you can actually trade value between the machines itself. We build that into the machines, and now the machines start trading autonomously. The whole key is we do research and advisory only. Everything else is done by these autonomous machines. These autonomous machines don't have hedge fund managers. They don't have a lot of the expenses. They're robots, okay? So disintermediation, they cut fees down significantly.
And they're picking the tokens? Or is that from you feed your research in, and they go out and buy the tokens?
There's a rudimentary binary set of questions to weed out the obvious that you wouldn't want. If the entity that's requesting token access, or whoever fed the request into the machine, if it passes that, then it will refer to the research arm for forensic analysis. Forensics are just too much for machines, even big machines. You know, they're not going to take my job just yet. But asset managers, watch out. So, anything else? I like that tie.
Thank you.
Okay.
Reggie, a question. So, if I were buying a mix of, if I have your token, your recommendation is to buy a mix of, 3 different altcoins, let's just say.
Mm-hmm.
You're saying that I'm giving the machine my positions. Where's it? Am I taking my U.S. dollars, converting it, buying those, and then feeding it into the machine? And then where are the tokens? Like if I have Dash, I buy Dash, Ripple, and Ethereum.
Mm-hmm.
And this is an Ethereum smart contract, where are those coins actually stored?
They'll be stored in the smart contract, right? The contract controls everything. You take your Ethereum, you take your Veritas tokens. That's your key to get in the machine. Think of a door. Like security gave a couple of us a hard time. You have to have a pass to get in. You have your Veritas pass to get into the machine, right? And it's a price, so you pay, say, 400 Veritas to get in, okay? And then you fund the rest of it with Ethereum or Ether, okay? Now the machine has your tokens that it can use as capital to go in and purchase other tokens. Okay, and it purchases the other tokens based upon what it feels is the best decision to make. Okay, as it gets more advanced, have it go sell tokens, of course. You got to short tokens, so it could go long this, short that. For instance, anybody, I told everybody short Snap as soon as you can. We had this discussion as soon as it came out. I was discussing with my son. Snap was free money on the short. It's absolutely free money, and it still is. Okay, so when the machine decides that, it can possibly go short as well. In order to go short, it has to go through exchanges, API issues, so these are things that be worked out. But that's, the answer to your question, the long and short of it.
Right, but it's going, but the contract is going out, it's taking Ether, and it's going out and buying, the combination of Ripple, Dash, and something else.
Right.
Whatever exchanges you have an API with.
Right.
So are you, like Poloniex or whoever
Right.
You're going to have contracts with specific exchanges that can take positions.
Right.
And then how do I know what my position is. I guess, do I get my private key for each of those?
Yeah, well, you have your private key from when you send your. You're going to send the Veritas from your address.
Right.
It knows just what address it came from. Okay, so remember the blockchain leaves a trail. So when it's time to redeem your Veritas and or your ETH or the tokens, it goes back to the address that it came from, which is yours. Now you're probably asking about reporting. Are you asking reporting?
Well, yeah, a little bit of that. I mean, and then what if there was if the recommendation is to buy a combination of, like I said, Ripple Dash Ethereum. What if I decide tomorrow on my own that, you know what, I actually want to dump Dash today?
Well, you can't do that because you've given you've given those tokens to the contract. The contract is autonomous. So if you want to do that, you can do it on your own, or you can wait to a redemption window to pull your tokens back out. But you can't control the contract.
But so, and I know you don't like this language, but it's like as if I invested my money in a mutual fund, I don't have full control over what that mutual fund does.
You're right. I don't like that.
I know you don't.
I don't. So there's this is, I consider this dynamic research. This is what research should be. You have the option for research to be autonomous, or you can act on it yourself. Autonomous, you send your tokens to the contract, act on it yourself, you can purchase research from us. The research is in machine language, so only the contract can understand it. If you want it to be human readable, you have to interact with a separate contract that will make it human readable, because the research is going into the contract, it's designed for the contract. Now, as of right now, we're the only ones that ever did a real research report. And the 2 or possibly 3 analysts are going to hit maybe one every week until we cover everything and cover them quarterly. I can easily see where there's significant demand to have research done because it lends an air of credibility. Okay, my name has weight in like circles with like 4 or 5 people around the world somewhere. Okay, and so if there's demand for this S&P stamp, A rate, B rate, B minus, C, etc., then that creates, again, more upward pressure for the tokens, and you actually have a revenue stream, because now they say, can you review my token, can you review this token? Everything that's done can only be done with Veritas. That's the key. So any interaction with us, if you don't have the Veritas in your hand, we don't speak your language. So it's part of the business model. We take the Wild West, we're trying to tame it, yes.
Let's take put technology aside.
Okay.
So you hire an analyst that will do research on the companies which are behind those currencies.
Or the tokens
Right.
themselves.
Before this analyst will work in a hedge fund, now you're taking this analyst and bringing them to your company. And how is it different that these same people who did research of, let's say, Microsoft, are going to perform better by researching not Microsoft, but let's say Consensus or Dashcom?
You said, how is it? I don't understand the question.
So the gentleman was asking, where is your product, where is your service? Are you managing funds? Like, are you creating a virtual portfolio?
Right.
If suppose you're creating a virtual portfolio, it means you're doing research on the companies which are behind those tokens.
Right.
How would you argue that the research you do on those companies behind that portfolio will be any more valuable than research those people did for hedge fund where they worked across the street yesterday?
Okay, well, the answer to that's sort of easy, because the one thing about finance-based performance is it's provable. This time next year, this time next week, next month, next reporting
there is
period.
zero proof in tokens, because in hedge funds there's 20 years back. Here there's zero history.
Every
You're
hedge
just
fund
taking
starts.
people fresh in cryptocurrencies and saying that they're gonna outperform the hedge funds by hundreds of percent. But it's just a statement. There's no data behind your statement.
Well, every hedge fund starts, so you don't have 20 years of data for all hedge funds. You don't have 20 years of data for 20-year-old hedge funds. The basic understanding, like if you take a look at the report, I'd love to share it with you. The report shows a fundamental understanding of the business. And if you approach it from the typical, say, Deloitte analyst or E&Y accountant, they're going to start looking for margins, they're going to start looking for earnings, and it just doesn't fit. So just reading through the report, I think you can see there's a basic understanding of how the business works. Okay, number one. Number two, you don't really have a choice. That's far as just me you have to go to. And number three, it's provable. So XYZ time units in the future, cross-reference it to where we are now. Okay? And, did it work? Did what he said was true? Did it pan out?